Welcome to Credit Matters. I'm Mike Skirbo, Senior Director, Standard & Poor's Corporate Ratings Group. Today we're going to talk a little bit about the recent rating assignment on general growth properties. I'm joined by Scott Sprinzen, who's a Managing Director in our Commodities, Real Estate, and Materials practice. Scott, thanks for joining.
My pleasure.
Let's first talk about let's set the stage and talk about some of the factors that precipitated the bankruptcy filing of general growth.
Okay, well, it really goes back to the fall of 2008, and it was much more of a financing or liquidity issue than a solvency issue. The company historically had grown aggressively, both through acquisitions and internal development projects, and had accumulated a pretty aggressive debt load. And apart from having aggressive debt leverage overall, they also relied heavily on short-term debt and CMBS. And they had a lot of maturities come due in late 2008, and with the turmoil in the capital markets at that point, they weren't able to refinance. Mm-hmm. And they tried to negotiate informally with their creditors for a period of a few months, but ultimately in April of 2009, they filed for bankruptcy.
Okay, so while in bankruptcy, how did the company go about restructuring the obligations as well as financing themselves throughout that period?
Okay, well, on the operational side, it wasn't as radical as in some bankruptcies, although in conjunction with the company's emergence from bankruptcy, they spun off some of their development projects, which faced a much less certain future than their mall properties. Mm-hmm. But the more significant restructuring was on the debt side, where they restructured the overwhelming majority of their property level debt to push out the maturities. The overall leverage is still relatively aggressive, but they have a window of a couple of years without significant debt maturity, so that they'll have an opportunity to refinance that in the current market.
Okay. How about the new ownership structure as well as management? What's our view on that?
Well, that's something of an uncertainty at this point, and it does represent a constraint on the rating. One thing that fueled the restructuring of the company and enabled the relatively quick exit from bankruptcy is that they were able to attract a lot of private equity money from the likes of Brookfield, Fairholme, Pershing Square, mm-hmm. Blackstone. But those companies are definitely in control given their board representation. Mm-hmm. Also, Brookfield basically appointed a CFO, taking one of their executives to fill that slot. Mm-hmm. But as to what their longer range plans are for their investment in GGP, that's really an uncertainty at this point. And also, it was announced a couple of months ago that the company is replacing its CEO, and they've recently mm-hmm. appointed someone, Sandeep Mathrani, from Vornado, who's a well-regarded executive in the real estate industry, but who lacks extensive mm-hmm. Regional mall experience. So again, there's a certain lack of clarity about what the strategy will be at this point.
Sure. I want to go back to the statement you made about the rating. This was General Growth was a company that was investment grade, rated investment grade prior to bankruptcy. We assigned an unsolicited BB corporate credit rating. Maybe you can talk a little bit about ratings upside or what the potential is for the company to be rated investment grade again.
Well, I think the main thing that they would have to accomplish to achieve an investment-grade rating at this point is pretty significant delevering from where they are now, mm-hmm. Both in terms of debt to cap or EBITDA interest coverage. They are relatively weaker than the overwhelming majority of BBB category REITs that we have rated. But beyond the balance sheet, we need to understand better what the growth strategy is going to be here. Even beyond the company's bankruptcy restructuring, they still have some pent-up restructuring to do. They've talked about further divestitures and downsizing. But beyond the next year or two, we would expect that they're going to be in a growth mode once again, and we'll have to see what form that takes and what the financial policy is behind that.
All right, let's just switch gears, Scott, a little bit. I want to talk about issue-level ratings. In this case, we rated the unsecured notes higher than the corporate credit rating, a bit unusual relative to criteria. Maybe you can just talk a little bit about the factors that drove that.
Right. We came out at a BB+ on the senior unsecured debt. Again, that's an unsolicited rating. That's one notch above the corporate credit rating, and it's derived from a recovery rating of 2, which speaks to our expectation of a 70 to 90% recovery in the event of a payment default. Which is a high recovery for senior unsecured, as you say. But we have a very important recent example here, and that's GGP itself. In their bankruptcy, it was one of the rare cases where all the senior unsecured holders at the corporate level came out whole. In fact, with the influx of new equity investment, even the existing shareholders received a pretty sizable recovery. And with the company, the way it's positioned now, they have basically the same well-performing properties in their portfolio that they did previously, with significantly less debt at the holding company. So even applying fairly conservative haircuts to the asset values, we would think that if the company ends up in bankruptcy, that once again there would be decent recoveries at the unsecured level. And if the company did end up back in bankruptcy, it most likely would be the same reason, because I said they have something of a window of a couple years with light debt maturities, but beyond that, the maturities are sizable. So unless they can address that through refinancing over the next 2 years, they will once again be somewhat vulnerable to capital markets conditions.
Sure. Well, Scott, thanks for joining. Appreciate your time.
Okay. Thank you.
We'll see you again next time.